Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
To take a closer look at markets and economic growth for leading countries around the world and the region is Brian Jacobsen with us, Chief Economist at Annex Wealth Management. Brian, the weaker non-farm payrolls report took a little pressure off for those who are really worried that strong growth will keep inflation higher and thus central banks higher. But the thing is, inflation remains sticky. Do you believe that we'll get a drop in inflation numbers that might match what we saw in jobs?
Yes, we do. Yeah. So here at Annex on our investment committee, we were looking at some of the data, and it does seem to us that the first 3 months of 2024, we've seen those upside surprises with inflation. So it's just still too hot to handle. But underneath the surface, there is still that goods price deflation that is taking place, especially with durable goods. It does appear as though wage growth has really moderated. And so perhaps that is then going to lead to service sector prices actually shifting from that rather high inflation to something a little bit more tepid. So we actually are optimistic that the first 3 months of 2024 are not a prelude to what to expect for the balance of the year. So we do expect to see a decline in inflation pressures here.
So if inflation is coming down and growth is softening ever so slightly, what does that mean for the equity market? I mean, are you playing this solely on the fact that there will be a little bit more liquidity added when rates come down? I mean, shouldn't we be concerned about the quality of earnings going forward?
We're always concerned about the quality of earnings. One of the things that we oftentimes focus on when we're looking at individual equities for client portfolios is to make sure that we have confidence that those companies are going to be able to maintain or expand their margins relative to their industry peers. And so that's kind of like an initial screen that we really like to look at. And we are a little concerned about the health of some of the areas as far as the vulnerabilities to a consumer slowdown. Maybe that's one of the reasons why year to date an ETF like XLY, which is the sector ETF for consumer discretionary, has been underperforming the broader market so much as because not that the consumer isn't doing well now, but it is likely that they're going to be coming under further pressure as the year goes on. With the wage data that we saw, I think that it almost validates that idea. You only saw a 0.2% month-on-month increase in wages, 3.9% year on year, and we still have relatively high inflation. So the real purchasing power of consumer incomes isn't growing as fast as what it used to.
I wonder whether or not the little bit of softness that we see in the consumer might be offset by strength in industrial, because we have this other whole trend of, obviously with AI and with industrialization and reshoring and all of that, that might be propping up the economy because we fear about the consumer, and yet the numbers overall are sort of okay.
That's absolutely correct. And really, you can see this in the ISM data. The ISM manufacturing index was below 50 for 16 months in a row. Then we briefly went above 50, and now we dipped back below it. At the same time, the ISM services index was above 50, and now we just recently went below it. We actually believe that we will be seeing manufacturing beginning to get some of a footing here because of some of the investment in artificial intelligence, maybe the efficiency gains that can come from that, government spending on infrastructure. So there are some things that we believe can really help the industrial area, and industrials is one of those sectors that we do have a preferred view on, along with materials. They have underperformed for a while. Valuations to us look fairly reasonable, as reasonable as what they can be in this type of environment. And so we actually do think maybe the baton is being handed from the consumer to more manufacturing and industrial for growth.
So we focused a lot in this conversation on the equity side. I'm wondering how you view fixed income under these conditions that we've been describing.
Yeah, it continues to be challenging. It seems like really it does depend a lot on government deficits, the Treasury refunding operations. As far as the quarterly refunding report was about in line with expectations, so that was encouraging. We think that maybe the U.S. Treasury has gotten some religion as far as being attentive to what the market is actually expecting and trying not to make any adverse surprises on that front. But really, we don't see a huge upside for bonds in general. We think that it's an environment where it's more about clipping the coupon. And it really, if you think about a year from now, where are we likely to be with the Fed funds rate? Probably maybe 100 basis points lower. Perhaps that means the 10-year Treasury can go down 50 basis points, maybe 75 basis points on a good day. That's a decent capital appreciation, but really we're viewing bonds more as for just where is it that you can get that good income. And a lot of that we're finding is more on the shorter term investment grade side of things.
If I could throw a little shade on my earlier question, among the adages that, we all put a lot of faith in, don't fight the Fed, and also that the consumer is about 70% of the U.S. economy. Given that question and your answer, is that relationship changing a little?
Well, not necessarily for the markets, really. You're absolutely right as far as with the economy. So economic growth in the United States is heavily dependent upon the consumer. Now, when it comes to corporate profitability, the earnings per share of the S&P 500, that's where we think that it's really more important about the global growth story. Are we going to see some sort of maybe reacceleration in China? Europe emerging from their recession. So really, it's more about manufacturing and global growth as opposed to just purely consumer spending that's likely to drive EPS or earnings per share for the S&P 500 or even the broader market.
Well, Brian, I'm glad you mentioned China and Europe because my next question had to do with opportunities that you may see offshore. Is there anything that's a compelling buy right now offshore?
Oh, well, for us, we actually do like emerging market debt. We think that maybe the currencies can appreciate from here, decent coupon income, and even China. A lot of people have kind of thrown in the towel on them, declaring it to be uninvestable, but yet the valuations may be maybe a good area for us to be looking at for longer term investments.
All right, Brian, thanks so much for joining us here on the program. Always learn a lot when you come on. Thank you for being with us. Brian Jacobsen, Chief Economist at Annex Wealth Management. One of the top stories of the day, Chinese President Xi Jinping has arrived in France and will begin today a three-nation swing through Europe. This is all to try to improve relations with Europe at a time when relations have been a little strained and very tough with the United States. Joining us now for some discussion of this is Oriana Skylar Mastro, a fellow at Stanford University's Institute for International Studies, with us. We heard from Emmanuel Macron asking for a reset in French or European China relations. We can interpret that in a number of ways. I think a lot of people are curious here at the outset of this trip, Oriana, whether or not Europe is going to continue with the process of toughening its stance on China, or whether or not it's going to use this trip as a way of trying to smooth things out.
Well, that's a great question. I'm an expert on China and not on Europe. But if I had to speculate, I think even the view that Europe has been tough on China is a little overblown. The reason that China is going to a place like France, for example, is that they have gotten these signals from Europe that these countries are, to a degree, prioritizing their economic relationships with China. And so there is an opening here for the Chinese to try to dangle some economic benefits in front of, U.S., European allies and partners, and hopes that these countries will consider more those economic interests over the strategic interests that the United States wants them to keep in mind, whether it's pressuring Russia on Ukraine or putting more pressure on China in this sort of strategic competition that is currently ongoing between Beijing and Washington.
Well, Washington and Brussels seem to be pretty unified when it comes to the issue of Chinese overcapacity on the manufacturing side. You mentioned war in Ukraine. Do you think President Xi is trying to find a chink in the armor, so to speak, and drive a wedge in that to try to create maybe a little bit more differential between Europe and the U.S.?
Oh, absolutely. I think there's a lot of commentary from the Chinese side that they do believe that if they strengthen political cooperation and economic interdependence with Europe, they could use that kind of as a bargaining chip, warming relations between China and Europe to stabilize the relations with the United States. And so it is kind of a multi-step, multi-tiered strategy that in the end gives them an upper hand in the competition with the United States, and ideally, from their perspective, reduce some of the pressure that the United States and its allies is putting on China in the economic and trade sphere, of course, but also in the military and strategic sphere.
Something that has languished a bit between China and Europe is a bilateral investment treaty. Do you expect to see any progress on that during these 5 days?
I think we would be hard pressed to see progress on that in these 5 days. It is, from the Chinese perspective, hopefully a first step to be able to push some of those initiatives through, right? Things that were already signed, but we don't see a lot of implementation happening. And so maybe there'd be some sort of agreement for further discussions or further talks about implementation. That would be seen as a big win. But if anything comes from it to make progress in the bilateral investment treaty, it will be in incremental steps.
You could make the case that there is maybe a little bit of difference between where France is and Germany happens to be on the manufacturing stuff. I mentioned the EV. There is also the medical device issue. But I think that France and Germany are pretty aligned when it comes to war in Ukraine. Do you think there's any way that they could get China to take a tougher stance where Russia is against Russia in what's happening in Ukraine?
I think unless there is some real cost to China for its closer military and strategic relationship with Russia, the Chinese are not going to see it in their best interest to pressure Russia and create that distance between them. So it's only if they thought there were going to be some significant economic costs, like European countries were going to put some sort of sanctions, secondary sanctions on China for their support of the war, that the Chinese would consider moving away. But from now, if it's just kind of a naming and shaming thing, or diplomacy and just, criticizing them for the policy, I don't think that's going to be a significant enough disincentive from their perspective, given everything they get from that relationship with Russia.
Is there frustration on the Chinese side about relations now between China and Europe and China and the U.S. Having shifted a little bit more to the ideological side and not so much on the practical side, the doing business side? Is that something that is tangible?
I think it is. The United States has been trying to argue that this is not just a conflict of unfair trade practices or even territorial disputes and conflicts in Asia, but we have a China that is a threat to the liberal international order, and the United States, with its allies and partners who tend to be liberal democracies, have different interests from the autocracies of the world like China and Russia or North Korea that are coming closer together. So China has tried for the past 25 years through a variety of strategies that I lay out in my book coming out next month, Upstart, How China Becomes a Great Power, to create that divide and say this is not an ideological battle, because they don't want European countries and the United States to form this type of coalition and to prioritize things like human rights and these ideological battles over economics. So during this trip, they're going to try to push this idea that it's much better to do business with China and ignore some of those factors.
What do you see as the biggest risk to China in following the trajectory that you lay out in your book? Is there one major potential pitfall?
Well, I think the biggest pitfall is I lay out in the book that they were able to build power largely by doing different things than the United States does. But we see under Xi Jinping, the reason they've done that, one of the reasons, is they were trying to avoid a backlash. But domestically, you now hear this argument being made that no matter what China does, there's going to be pressure from the United States. So they're no longer prioritizing and playing nice. And if that's the case, it does seem like they have more incentives in the future to be more aggressive. And they also have incentives to abandon some of their smarter strategies that were more effective. And so what that means is, on one hand, we can expect a more aggressive China in the future, but on the other, one that is not going to be quite so successful in their pursuit of power as they have the past 25 years.
We always had an ideological angle. We had the annual MFN tussle between the U.S. and China. But then it switched to a more on the practical side. What do you think changed things back to the ideological?
Very quickly.
The single biggest thing. Trump?
I think we came to the realization that China, you can't create a distinction between the ideology, the economics, the military, any of it. China has a brand strategy that brings all those components together. And so if we're going to protect U.S. interests and allied interests, we have to consider all those components together as well.
Oriana, thanks so much for being with us. Oriana Skylar Mastro, fellow at Stanford University's Institute for International Studies.
The bull case for Chinese equities appears to be more compelling than it has for a long time, and investors seem to be gradually dipping their toes in, despite what is being called the deep scars of last year. Mary Nicola joins us now. Mary is Bloomberg M-LIV strategist who joins us from our studios in Singapore. It's always good to chat with you, and I'm wondering, is this something that's going to be durable in your view, or is this maybe just a quick sort of recovery that may resume? I mean, the weak trend would resume before it's too long from now.
Yeah, I think this time around, there's just a few more catalysts to help support this rally. So if you look, we know valuations have been cheap. That's nothing new for us. But look at some of the other factors. So take, for example, the equity risk premium, which is the difference between the earnings yield for equities and the government bond yields. They're actually showing you that you are getting compensated for taking risk. So that's one factor. And it actually has been improving. It's above its 5-year average. So there's a case there that you're getting compensation. The second factor is that you are hearing more support from policymakers, and again we have heard this numerous times, but this time the Politburo was focusing on two things that, you know, for someone like me got excited, which is the fact that they're looking at ways to help with consumer demand, and they're looking at ways of figuring out what's going to happen with housing. Obviously, we know these are the two issues that have been the underlying key thing that has been dragging down the economy. So they're now targeting those two things, and that's what they mentioned at the Politburo meeting that closed out on Tuesday.
Completing units that are in the process of being built and getting those to people. Walk us through how that winds up being also adding to the bullishness.
Yeah, absolutely. So there's so much supply out there. There's also a lot of people who haven't gotten their apartments, and obviously that's weighing on sentiment. The fact that, you know, we've seen a lot of that move from property, and they're looking for ways to put their wealth in gold. That's another factor, obviously, that's been weighing on the equity markets. But if the government takes charge of, you know, of delivering on a lot of these housing projects to people and putting them back in their hands, that is a big positive support for the average consumer.
I'm glad you mentioned gold, because Brian and I were talking earlier about a story in the New York Times over the weekend. Chinese consumers have flocked to gold really fast here. I mean, I think they're buying it hand over fist as confidence in traditional venues like real estate and equities have faltered a bit. Do you think this is also a temporary phenomenon?
You know, there's a lot to be said for gold at this point, especially if you're seeing, and if your if expectations are that, you know, growth is going to continue to be on the weaker side. That's just the long-term trajectory for China growth, right? So it has nothing to do with anything else, but this is where we're heading from a long-term perspective. So you have that supporting gold, not to mention you're expecting currency weakness. Bond yields are quite low. So, and then the housing market, you still don't have the confidence to jump back in. If you think about it, where the most, the average Chinese put their wealth, they put their wealth in the housing market, and that's really dampened their confidence. So for now, it's going to be about gold, of where they can put their wealth, and that seems to be a beacon of stability. So they're going to always have that little bit on the side as a part of, let's say, their portfolio.
In the overall picture about looking at a little bit more in terms of bullish conditions for Chinese equities, we haven't talked too much before about some sort of China discount, like we've seen with Korea for a long time. And if that is permanently baked in, how much of a constraint does that offer?
Yeah, I mean, there is, because of the fact that you've had all this piecemeal stimulus that's come through and nothing has really gotten people excited or really gotten things going from a growth perspective. So to some degree, there is the concern about the unwinding of a lot of the stimulus that they have put in or some of the regulations that they may impose. Because we have to also remember the start of the rally was really based on, the trading regulations and the buying from the national team. So now it just needs another oomph, right? So they've been putting it through the 9-point plan where they're trying to help with companies give out better dividends or improve their profitability and really focusing on that. And that's absolutely crucial and absolutely critical in terms of looking at valuations. So it's all about the follow through, and it's going to continue to be about that.
So when we were talking about gold a moment ago, you linked it to the weak currency. Well, the weak currency has been a positive where the export economy in China has been concerned. And there's been a lot written recently on how strong that is. Is there a risk that that trend could maybe adjust a bit, soften a bit if the currency were to recover?
I don't think so. I think there's been an export boom more globally. So we've seen it not only in Korea, in Taiwan, and obviously they have the AI backing them. But at the same time, you still have this export global boom and an export recovery. We've seen it in a lot of the numbers across this region, especially in, let's say, intermediary goods and final goods as well. So that's going to continue. And, and if you look at the CNY, sure, against the dollar, it's weakened. But if you look at it across versus other currencies, it's actually been doing pretty well, and yet the exports have been holding up.
Mary, it's a pleasure to have you on the program. Thanks for joining us. Mary Nicola, Bloomberg M-LIV strategist.
This is the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen. And always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.